Tonight, we want to get into this issue of buying term or buying permanent insurance. This is one of the exam questions. This is the squirreliest one. The second exam doesn't have any squirrely questions. This one, you have the ethics questions, which you're already working on. You have paper one, which you're working on. This is the second question. I don't essentially give you the answer in the notes. I'll just show you the two arguments as they're presented to me. So in the late 70s, this is the time when the industry is going through flux as it is. And then this guy shows up, Art Williams. He starts a brand new firm called Primerica. You may have heard of Primerica. Industry didn't like Primerica. I'm not a big fan of Primerica, but I do like their argument. Their argument was buy term insurance and invest the difference. And what they meant was term insurance is cheaper. So term insurance is $50 a month, but whole life is $500 a month. Buy the term and invest the $450, and eventually you'll have more money in the long term. It's an argument I agreed with. Where I disagree with them is you didn't either buy term from them or invest with them, because their term insurance was really expensive and their investment products were really expensive. So like buy the argument, but don't buy it from them. But their advantage, Primerica had the best sales force in the industry. They were hiring just people from the military, school teachers, firemen. They're just hiring just normal people who had a lot of friends that trusted them. And the argument sounded really good. You know, why are you wasting money on whole life insurance? Buy term and invest because the stock market's doing well. You know, he's jumping into the stock market, high interest rates. So he came in at this time, an impressive guy. If you look at his story, he did have some legal troubles that were pretty serious. Primerica's interesting in that it's gone through several iterations. At one point, it was purchased by Travelers Insurance, and then Travelers Insurance spun them off. I don't know where they are today. If you watch Primerica back when I was in the industry, you may have seen some of these multi-level marketing firms like Amway and those type, and their conferences. Everybody's just screaming. It's like, you know, this frenzy. That's the way his salespeople were. They were just dedicated to this company, really good salespeople. So I'm not going to recommend his firm, but we're going to talk about his argument. Should you buy permanent insurance? We'll talk about whole life in particular, where you pay a fixed premium for the entire rest of your life. Or do you buy term that only lasts for, say, 20 years, but it's a much lower premium, but as long as you invest the difference, are you going to be better off or worse off? And that's his argument. And so what I did is I went to Art Williams webpage when it existed. I don't know if it exists now or not. I mean, it'd be a good question. Every semester, always check. So primerica.com, see if they still exist. There it is. How money works. Term life. They don't sell whole life insurance. There it is right there. Buy term, invest the difference. It says it combines with a sound investment strategy. At the time I was seeing that, then their investment strategy wasn't all that sound. So it looks like it's essentially the same company, but it was spun off by Travelers, and it looks like it was spun off exactly the same as before. If you want to find a rep, you know, we could try. I hate to do that because now I'm going to get like a million phone calls, but this is their thing. They were really good at selling this stuff. So let's ignore the company and just look at the argument. So I'll tell you the ones I think are the most important. You probably already know which one I think is the most important. We'll get into that one. But the first thing you argue is why combine your insurance with your investing? There's a good book, you know, you think Primerica came in and did this, but there was a book in the UTSA library. I don't know if it's still there, but it was published maybe in the 40s or the 50s, where they were making this same argument. Why would you combine your insurance with your investing? And he made the example of auto insurance. Would you buy auto insurance if State Farm says, okay, your auto insurance is $1,200 a month? You go, $1,200? What are you talking about? I mean, let's look at this. This is the argument he made. So auto insurance. $1,200 a month. And you're like, what in the world? That's crazy. He said, well, really, it's $400 a month, but we'll take the extra 800 and invest it for you. So it's really not that bad. So, well, why would I do that? That sounds pretty crazy. So, but you'll have a cash value. So, well, that's really, really good. Let's say you have a cash value after 10 years, maybe it's $25,000. Whoops, that'd be really good. So that sounds good. All right, well, is there an advantage me for combining them? And they can't come up with a reason. Say, well, I don't know. I guess I could do that as well as anything else. And they say, oh, by the way, if you have a car accident, we'll pay for it by giving, we'll pay for it with your cash value. So you have a $10,000 accident. Well, just take 10,000 out of your savings and that's what will pay the accident. You're like, okay, wait a minute. I'm not following you. Why am I investing this? I'm paying $400 for auto insurance, but I have an accident. You're going to take the money out of my savings account? Say, yeah, that's the way it works. Does that sound like a good deal to anybody? And essentially, that's what the life insurance is doing, the whole life. They're saying, well, we really only need $400, but we'll put the extra away so you'll have a cash value. Oh, but if you die, anything in cash value, we're going to use that to help pay your claim. So you're going to lose that anyway. So the only way you get the cash value is if you surrender the policy before you die. So that's what that book, this was in the library, a book written in the 40s or 50s, making the exact same argument that AOM was just making. So he's not coming up with this. This was an argument made. I wish I had that book. I should have bought it. I should have just checked it out and never returned it and then paid the penalty because I don't think it's been published since. I haven't been in the library in so many years. I don't even know how to get stuff from the library. So just completely separate. Why would you combine this? You don't combine your grocery shopping with savings. You don't combine anything else with savings. It just doesn't make sense. So separate these two. They're very different transactions. The second argument he makes is, well, term is cheaper, especially when you're young. I should have, if I were doing this, I would have brought number 5 up next to number 2. So I would combine these two because they really are related. So it's the lowest cost of insurance when you're young. And when you're young is when you need life insurance because that's when you have dependents. So buy term when you're young. You have kids, maybe you have kids in your 20s and they'll be out of school on their own by the time you're 45. So buy term when you're 25, get a 20-year policy. By the time you turn 45, your kids are hopefully out of the house. You don't need life insurance anymore. You spent as little as you could for the insurance because you bought it when you were young and you had insurance when you needed it. So those two arguments go together. Obviously, if you do that, you'll have more money to invest because you'll pay less for the life insurance, so you have more money to invest. Now, sometimes I confuse it and I put the counter argument in there. I shouldn't have done that. But the big question is, if you buy term, what do most people do when they bought this argument? They bought term and did what? Spent the difference. So now what happens? So it's a little bit different argument. We'll talk about that. The study I saw, which is a pretty old study, was that about 80-something% of people bought term and then spent the difference. So essentially what it did is on people with no savings. But if you buy term and invest the difference, that's what he's saying, then you'll obviously have more money to invest. But if you don't invest it, you just spend it, you lose that benefit. The next argument he makes, which the insurance industry is somewhat killing this argument, but he said you have more control over your investment program because you buy whole life, you're buying insurance and your investment from the same firm. And he's going to argue, why don't you buy insurance from the best firm and buy your investment from the best firm? Why would you combine these two? This is part of the reason Travelers bought Primerica. Travelers in USA kind of started this, which was the, what was kind of the bundling idea, buy everything in a package from one company. And that was the USAA model. USAA really cornered this with the military. Hey, buy your auto insurance with us, or your life insurance for us, your investments for us. And that was the idea Travelers had. Let's buy Primerica. So when people come to Travelers, they can buy auto insurance, homeowners insurance, life insurance, investments. We got it all bundled together. It worked with USAA. Although USA is struggling here recently, they're still a great firm. They have a lot of our employees. I've had lunch at USA a couple of times in the last few weeks, just meeting our alums. It worked for USAA, but what Travelers realize is if you have a bank and you're selling banking products and insurance products, the regulators require you to keep those completely separate. You can't walk in and have one person do all that for you. Why? Because the federal government doesn't want you thinking that you have FDIC insurance on your insurance products. They want to make sure you know they're separate. So there's a pretty sizable wall. USA has gotten around it because they're direct writers, so everything's by phones, so they can easily switch people back and forth. But that was Travelers' idea. Citibank tried this as well. In fact, I think Citibank owned Travelers at one time. So Citibank tried this. It did not work for Citibank. What did USA have that all the rest of them didn't have? USA had one thing, and it's called trust. Their customers trusted them. They've lost a little bit of that, but for the longest time, USA was just trusted. So they would buy everything from USA. It was hard for Citibank and Travelers to set that up. And so, yeah, that's what Primerica is saying is, hey, why combine things that really shouldn't be combined? Buy your best insurance, buy your best investment products, and don't mix it. Now, some people say, well, Americans aren't well trained in investment management, and that's absolutely true. But both of these arguments have been somewhat destroyed by the insurance industry because remember, the insurance industry unbundled with those variable products. They say, hey, we'll let you get any product you want. We'll just give you all these choices. So part of this argument has been destroyed. The life insurance industry has essentially given their customers more choices on the investment side. So I think this one somewhat has gone away. But it does point out that Americans are pretty bad at picking investments because they tend to chase performance. This is my favorite one, and it's in 2 answers on your exam. Hit the wrong button. So remember on the ethics question, why is it so easy for salespeople to sell these really horrible products? Because you can't comparison shop. A.O. Williams and Primerica made that same argument. It's really easy to comparison shop term insurance. If you have 10, 20-year term policies, you just take the one with the cheapest premium. It's really simple. There's not much analysis you need to do. So that to me is the most important one. All these other arguments really depend on if you actually invest the difference. The next argument, I don't think it's a strong argument. I actually think the life insurance whole life has a better argument that they said, hey, if you need your money, you take it out of your investment program, you don't jeopardize your life insurance. I don't think that's a strong argument. The problem with taking money out of your investment program is the tax consequences. What if your money's in a 401k? You can borrow from your 401k, but it's kind of messy. If you don't pay it back in time, there's tax consequences, including penalties. So I don't think that's a very strong argument. I actually think it's easier to borrow money from your life insurance policy than it is to borrow money from your investment program. And if you sell your investments, you end up with tax consequences. I don't like that argument, but that was on Primerica's page. The next argument he made, again, the insurance industry has somewhat addressed this. So remember, he's making this in the late 70s. He said, when you buy a whole life policy, the amount of money you're getting paid on the policy is really low. Versus you come invest with us, we'll stick you in the stock market, you'll make 7, 8, 9, 10% returns. But remember, universal life, variable products, the life insurance industry started offering these more competitive products that could compete with the stock market and the bond market. So the insurance industry has somewhat addressed that one. And then this one's just, they had it on their website, but it's just the opposite of number 5. If you buy whole life and policy, then you're insuring yourself after you have income. If you're buying insurance to cover your human capital, if you have no human capital, why are you buying life insurance? We'll talk about that on the other side, because there is an argument that people actually do need some life insurance in their 80s and 90s. But he was saying, why are you buying this expensive insurance after you have no income? Because what are you replacing? So those are the arguments he put in there. I think number 6 is the best one. The other ones, number 4 and number 8, I think have gone away because the life insurance industry has produced these complicated products that somewhat address that. I think number 7, they're wrong on. So, and then the first few really depend on you actually investing the difference, because if you don't do that, let's look. So any questions on his, I took these practically word for word off his website. I don't know if it's still on his website today. He's been bought by so many firms, and I don't even know if he's still alive. I think I looked him up last time. His picture's probably out there. No picture. And somebody's update his page. That it show that he's still alive? Yeah, he's 83 years old. I should call him and have him talk to the class. Think he would talk to us? He and I could have a debate if he's still, mentally able to. He may be that. I think I saw something. He'd been married for like 70 years or something. There's some things about him that are a little shaky. There's things about him that are really very impressive. He does a lot of charitable stuff. So yeah, he's all over. He's all around there. All right. Those were his arguments. And then I bought a textbook for this class that I don't use anymore because I don't like it. This is one reason I didn't like it. It was so pro-industry. It was very unobjective. And that book argued, no, permanent is better than term. Why? Because that's where the insurance industry makes its money. So these are arguments from that textbooks. So he argued, okay, it's true, insurance pays lower returns. He's talking about whole life here, not the new fancy products. But that's because it's low risk. Because what do insurance companies buy? They buy bonds. Bonds are very low risk in securities, so they're going to pay a lower return, but you have lower risk. Now, what's wrong with this argument? Well, should you're doing this in your paper 1, should a 25-year-old be buying bonds? Probably not. Life insurance, yeah, it's a low risk investment, but they don't need low risk investments. They don't need a bond security. As you're going to talk about in paper 1, your human capital already looks like a bond. They don't need more bond-like investments. So that doesn't make sense. This argument, I do think, has some credibility to it. There is a need for insurance later in life. So it's pretty critical that they have something. So Art Williams is going to say, well, they have their investments, but if they bought term and didn't invest the difference, they're in trouble. If they buy this whole life, they have something. We're going to talk about that. There's actually a stronger argument for that, but people do need insurance later in life. This third one, I think, is completely nonsensical. People can't manage their own investments well. With Vanguard, I don't make investment recommendations, but I'll tell people, I don't make a recommendation, but if you go to Vanguard, you won't be disappointed 20 years later. Low cost, easy to go just buy index funds. I think today with Vanguard and index ETFs, I think it's actually pretty easy to invest and not get ripped off if you go to the low cost providers. But and then why would you trust the insurance industry to do this? If individuals can't hire the right professional staff on their own, why would they think they can find the right insurance company? Liquidity, I do agree with. This is the alternative on if you need the money. It is easier to borrow from your life insurance policy than to sell investments. I do think the insurance industry does make borrowing from your policy pretty straightforward. So this is, I think, the best argument. I'm going to take the highlight off of here. I like this one the best. It's, I keep hitting the wrong one. It's a form of what I call forced savings. A lot of people, if they have a whole life policy or even a universal life policy, they just pay the entire premium every month. They don't think about it. So they're saving because it's a bill. They feel like they got this life insurance bill, so they pay the whole thing, not thinking that part of it's going into a savings account. And some of those people, they're very, very fortunate they did that because that's about the only savings they have because they spent so much of their savings throughout their life. The investment world is making forced savings a little bit better, but it's not the same. You know, Vanguard will say, hey, you know what, if you invest electronically, our funds that have a $3,000 minimum, we'll let you invest as little as $50 a month. And we'll let you do it as a salary deduction. So there are some ways your 401k is kind of like that, right? Y'all are all going to be doing 401ks. So there is a little bit of forced savings. I will say at USAA 401k plans, one thing that irritated us so much, USA pays these massive bonuses. I was shocked my first bonus. It's just crazy how much they give you in one day. But on that one day, there was a lot of USA employees that would shut their 401k off that one day. It's like, why would you do that? The company's matching you 8%. You're throwing away that 8% on the day of your largest salary, but like, no, I want my entire salary on the bonus days. So I don't know, people don't make good decisions. So life insurance probably has a little bit of an edge here in that people pay it like it's a bill and they just keep paying it. And then suddenly at age 70, they got $70,000 sitting there that they really, really desperately need. And it's kind of nice that it's there. And this is the argument I was making. There are reasons to have life insurance later in life. If you didn't invest the difference, then, you know, at least you have something there to help you with that. So, I mean, the key here, I do believe term's the best way to go because of the comparison shopping. Most whole life policy, in fact, all permanent insurance is practically impossible to comparison shop because they've gotten so complicated. So I do agree with that if you invest the difference. But life insurance does provide some discipline that kind of help. It's kind of like Dave Ramsey, you know, some of the stuff he says, I just think is so ridiculous. Like he says, you have 4 credit cards, one's charging 20%, one's charging 6%. Pay off the one with the smallest balance. I'm like, no, pay off the one with the highest interest rate. But he says smallest balance. Why? Because you feel like you accomplished something. I just like, you're wasting thousands of dollars of people's money when you do that. But this is his argument. People are not rational. They're not disciplined. So he said, let's come up with a scheme that's not best economically, but it's going to force you to do something that's in your best interest. And because you're not very good at controlling, I'm like, well, get good at managing your money so you make better decisions. So with unbundled products, variable products, the insurance industry has essentially addressed some of this and said, hey, we'll let you invest your own money. We'll let you invest the difference. We'll give you life insurance with an investment product like you choose to invest it. So the industry has somewhat addressed this with these really complicated products. So would it make sense to buy a traditional whole life product? I actually think that's what my mom should have purchased. That simplest thing, that whole life policy with a fixed premium for the rest of her life. She bought the universal life policy, which ended up being a disaster for her. And so I had a friend of mine going into the military, about to get married. I think he was already in the military, about to get married. And he was asking me, do I buy term or invest the difference? So I took the term policy he was looking at and the whole life policy, and I actually did charts for him. And he's real excited I'm using these charts in this class. He's like, feels like he's gotten to be famous. So let's see. You have to put these charts, at least 2 of these charts, on your exam answer. Remember what I said earlier these charts are not in the exam. You remember that way back up here on the premiums? So wherever those are, these are not the charts, right? I think I even highlighted it down here. These are the charts for the exam right here. So let's look at one of these. It's going to be a little blurry. But let's look at this. So let's first get the axis down. The axis down here is age. Now, if you're an actuary, you never say age. You say, for some reason that I can't explain, so one of you actuaries can come back and tell me. Actuaries like to say attained age. I don't know what that means. I don't know the difference between someone being 70 years old and attaining 70 years old, but you actuaries go look that up and let me know. So technically, this is attained age. Anybody know why it's attained age and not just age? So whatever, but you attained it. So 27 up to 99. Over here is what you get when you die, right? And we're looking at two things. The blue line is your whole life policy. It's a $250,000 policy. So whole life policy, if you die, what do you get? You get 250,000 bucks, real straightforward. All right. Now I did a 30-year term, which is not that popular. Mostly it's 20-year term, just to make the math look easier. And when I did this, 30-year term was still pretty popular. So the orange line is 30-year term and investing the difference. And I use real life numbers. So I looked at his insurance premium and I said, okay, difference between that and whole life is this much, and I invested it. And on this first chart, I assumed I only made 3% on the investment. All right. So what happens here? Let's see if we can understand this orange line. So the policy is for 250,000 bucks. So between age 25 and 55, if he dies, he gets $250,000 from the term policy plus what? Whatever his investment portfolio made. How did he make that investment portfolio? Because the term policy was like $50 a month. The whole life was like $300 a month. He could invest that and for all those years making 3%. So if he dies right here, he'll get $250,000 from the term policy, and he have a portfolio of about $90,000. Okay, what happens right here? He didn't die. What happened right here? What happened to the term policy? It expired, no more term. So this drops by how much? About 250,000 bucks. Not exactly, but pretty close. But here what happens? He has more money to invest, right? Because now he's not just investing the difference, he's investing the entire amount because he's not buying the term anymore. At age 78, what happens? At age 78, he's better off. There's no life insurance here on the orange line, right? This is entirely his portfolio. But from age 78 on, so if he knew he's going to die before age 55, which would be the better choice? Buy term, invest the difference. If he knew he's going to die after 78, what would he do? Buy term, invest the difference, or don't buy any insurance at all, right? But buy term, invest the difference. Between age 55 and about 78, the whole life's going to give him more money. All right. What's going to happen as this earning rate goes up? The blue line's going to do what? Nothing, right? Just sits there. What's the orange line going to do? It's going to shift up. Okay. So over here is what he gets if he dies. It's either insurance, or it's insurance plus a portfolio, or it's just a portfolio, depending where he is on this line. I did 4 scenarios here. I did 3%, 4%, 6%, and then I found the break even such that he was always better off. So I took this point, what we needed to earn, so when the term fell, it would hit that 250. And that was a really high return, 858. 858 is a pretty hard return to make. It wasn't during my lifetime because stocks were making 12, 13%, but during your lifetime, making 8% would be really, really tough to do. 6%, you can make 4.5% on bonds now. Stock market's probably gonna make you 7, 8%. You can kind of get to that 6% earnings. You can see there's a little bit of difference, but what was that term I used with equity-linked annuities that might apply here? Maybe stochastic dominance, right? If you can make a return, there may be a few times, depends on when the market crashes, but these two would be what you get if you invest in the bond market, bought really safe bonds like treasuries, be a pretty sure investment. And so you would see how you could do. You would probably think this orange line's better here because even though you're a little worse off here, it's not that dramatic. And probably all your dependents have left the house by then. So you have, you don't really need as much insurance. So I was telling my friend, it kind of depends on how disciplined you are to investing, what you think you can make in investments. With whole life, the insurance company is going to just be buying bonds, which is why the blue line doesn't compete very well. If you can buy stocks, you have a higher expected return. You're probably most of the time are going to be better off buying term investing the difference, especially if you're a young person, if you invest the difference. So I like to put at least 2 charts on here just to demonstrate the importance of your earnings return. So 3%, I think anybody can make 3% today because the 10-year treasury is at like 4.1%. The 30-year treasury is at 5%, right? You could buy a 30-year treasury and lock in 5% for 30 years. Right now, you can really, really assure yourself of a 5% return. So I don't know, I haven't looked, the 30-year had hit 5. I don't know, I just confirmed, but the 30 years at 473, but it had gotten up a few days ago. I wonder when that was. Yeah, that's a holiday. But yeah, it wasn't that long ago, but I just can't find it now. No, that's pretty close, right? It's starting to get up there, 4.9%. So with the 30-year treasury, which are really easy to buy, I have a Schwab account, and buying treasuries is really easy. Selling the treasuries is a little bit of a pain because they can never find a bidder for me. But buying treasuries pretty. So you could lock in 4.9%. So you can see even these charts at 4% today. You could buy a 30-year treasury and lock in 4.9. And I don't have the Excel to get you there, but you'd be somewhere between that chart and this chart. So, but what does that mean? Well, what would happen to the whole life policy? Well, the whole life policy, its premium would probably be cheaper because interest rates are higher. So you wouldn't have as much to invest. So, it all matches together. So all of these lines might change as interest rates change because the whole life side is assuming some investment return. So the exam question is to essentially critique this buy term and invest the difference. I've given you the arguments. Some of them are better than others. You do need to put them all down and talk about the pros and cons on them. So this might be one you want to draft and show to me because it's a little bit of a squirrely question, but you got everything you need there, but you need to, in your notes, kind of catch up on the comments we made. Any questions on these? Y'all can tell I'm definitely on this side of the argument. If you're disciplined and you don't chase performance, put it in a good Vanguard low cost fund. And you probably will most of the time be better off than whole life. So why do I think my parents should have done whole life? Yeah, this is gonna be a recording. Hopefully my brothers won't see it. But my mom, she spent so much money, but never on herself. So it's kind of hard to get mad at her. She's always spending money on other people, but she was, it's like, Mom, you got a credit cards up to 25,000 bucks again. It's like, oh, that's okay. It's like, no, it's not. You're spending, so she would buy term and spend the difference, but not on herself. So it'd be like the worst case scenarios. So the fact that they had this permanent policy, she paid it like a bill and just paid it. So she at least had something there. when she needed it. So it was good. She just bought the wrong policy. She bought U-Life. So there are quite a few people in this category that just are not disciplined, and the insurance industry is, at least, they're used to paying their auto insurance, their homeowners insurance, the life insurance shows up, they just pay the bill. So there is that argument for people who just don't have that discipline. Right. Let me go back to the thing we said we left. Back on page 22. I told you term's really easy to comparison shop. You just buy the cheapest. Can you compare more permanent products? And there is a method. There's two methods, the traditional cost method and the interest adjusted. The traditional cost method doesn't really make any sense because it doesn't adjust for the time value money. The interest adjusted cost makes a lot of sense. The problem is getting your hands on it. So I mentioned AM Best earlier in class. AM Best would actually publish these indices and publish them in a way that you could compare insurance companies to see who really had the best product. It works really well for whole life. It doesn't work well for universal life, variable life. So it really only works really well for the whole life. But if you are buying a whole life policy, this is not a bad way to do it. Essentially what they're doing, both approaches are the same. It's just the interest adjusted method adjusts for the time value money. So let's look at that one. You can look at both of them in the notes, but what they say is a whole life policy is going to pay you dividends. That's money coming back to you. Let's take this money, but let's adjust it for time value money. Without time value money, it was only it was actually $196, but when we adjust it for the time value money, it takes it up to $200. Over 20 years, it was 10,000 bucks. When we adjust it for time value money, it's 14,000. So you receive over 3 years, $200. Over 20 years, 14,000 bucks. Your cash value, that's how much you get if you surrender the policy. After 3 years, that's 2,900. After 20 years, it's 3,500, 36,000, excuse me. This is what you receive. Over 3 years, $3,200 adjusted for time value money are 50,000. What do you pay? Again, adjusted for time value money. Over 3 years, you pay 7,200. So you receive 3,000, you paid 7. So your net cost adjusted for time value money is 4,000 bucks. Over 20 years, you paid 75,000, you received 50,000. So your net cost was 25,000. You'll notice when you don't adjust for time value, your net cost is actually a negative number. It makes it, in reality, you're paid more than you pay the insurance company. The problem is you pay the insurance company up front and they pay you back at the end. So when you adjust for time value money, you're actually paying them. And what we do is we take over 3 years, you paid 7,000, received 3,000, so you paid net 4,000. We adjust everything on a per thousand basis. So you can compare a $500,000 policy to a $300,000 policy. This was a $100,000 policy. So you divide by 100 because there's 100 thousands and 100,000. So your cost per thousand is $40. If you adjust that on a per year basis, you use the future value interest factor of the annuity, this policy costs you $12.31 per $1,000 of coverage. That $12.31 you can compare to other companies' products. And what do? You take the cheapest one. Over 20 years, your net cost is $746. So AM Best used to publish these. They were so entertaining to look at. Because what AM Best published, they would publish history and projections. So they would show these numbers with actual policies in the past. You can't buy that because that was 10 years ago, 20 years ago. And they would show what companies were saying they were going to do the next 20 years. And why were these so humorous? I loved it at UTSA because UTSA would usually rank 1 or 2 here, and they would rank like 15th here. Why? Because USA was so much more honest than everybody else. So the companies that ranked really high here ranked really low. So their projections were really, really, really rosy, but we looked at their actual numbers, they weren't all that good. Which would you trust better? The firms that did well in the past or the ones who said they're going to do well going forward? I go with the ones who did well in the past. So a USA and a few, there's a few that ranked consistently ranked high on the historical side, but their projections were more honest. And they didn't rank as high on the projection side. And so every time AM Best published this, I always look for, wow, there's USA up at the top. Oh, there's USA way down there. And we actually took it as a pride that we were good when you needed us and we're honest when you're trying to decide. You can't buy the history, but I think the history gives you good insights into the future. Is it possible a firm that's been really great in the past suddenly becomes a bad company? It's possible, but you're probably better off going with the history. I don't know if AM Best does that anymore because state law has changed and has limited companies on what they can do prospectively and is advertising about the future because there was so much lying going on. So it's useful. So if you have someone in your family that is buying a whole life policy, again, it doesn't work for universal life, doesn't work for variable life. But if you want someone with a whole life, you might go to AM Best website, try to find their magazine, try and see if they publish this or Google this index. And I would go with the companies that do well historically, because I think that's your best, most honest evidence. So there's life insurance. The next is annuities, but we're going to shift and we're going to do the math problem for question one, for exam one. All right, are you ready for that? This is out there on Canvas. If you look under annuities, it says Word equity linked annuity math examples. And these examples look exactly like the exam question. So what should be your point total on this exam question? It should be 100. Or everybody in class make 100? No, why? I don't know. The math isn't very difficult. I think we're in this kind of post-COVID world where there's some students like, you actually want me to learn something, memorize something? So I think COVID has made us just very different people. So it's shocking, but you actually have to know stuff. Students say, do I have to memorize this? I'm like, don't memorize it. You should just know it, right? Shouldn't you as a finance or an actuarial professional know stuff off the top of your head that you don't have to look up? You should just know it. This is a math problem you should just know as a finance or actuarial student. So don't memorize it, just know it. I actually want that as a t-shirt. Don't memorize it, just know it, because I think it's absolutely true. Students think I can just look it up on I don't know, Chat GPT. Right, this one is a problem, and there's actually a YouTube that walks you through it as well. I don't know how many views it has. Probably not that many, but it's out there. So let's talk about this product tonight. We'll go through it maybe once. The first time we go through it, you'll be like, okay, not quite sure I have it. And then we'll do a couple more problems on Thursday and you'll have it. And then we'll work one in class, maybe next Tuesday. So one thing to be a little bit careful on is we're going to use some jargon you may have never seen before. I don't know what your background is on an index call option. So let's just make sure. Any of y'all trade options in here? Val's probably does, yeah. Any of y'all don't trade options in here? So should you trade options? I don't know. I love trading options. It's a pretty cool thing to do. They're a little tricky when if they blow up on you. I was on a bike trip once riding and I had to do an option trade while I was on my bike and it just wasn't fun, kind of in the middle of my vacation. I did a lot of option trading for USAA. So I love options. What's the price of an option called? Premium. What's a life insurance price called? Premium. What is what is life insurance? What is auto insurance? It's an option. Did y'all realize that? Insurance is an option. You pay a premium. Auto insurance, you pay a premium and you get to sell your car to the insurance company at its adjusted cost. It is an option. Can you use option math for insurance? You absolutely can. I don't know any actuaries that do, but you could. So an option is the right, not the obligation, to buy or sell something at a predetermined price during a given period of time. What's the predetermined price called? Strike price. So you have the right. You don't have to do it, but you have the right to do it. Okay. How much is that worth? Well, let's do an example in the stock side. Let's do Oracle since the stock price just zoomed up. Probably again this week. Just keep zooming up. Let's see, last month. Yeah, kind of flat the last few days, but let's do an option on Oracle. So its stock price is currently, say, 315 bucks. So you can go out, you can buy Oracle for 315 bucks today. What if I say, hey, I'll let you buy Oracle for 320 bucks between now and December? That seems kind of stupid. I can buy it for 315 right now. Would you pay me any money to be able to buy Oracle for 320? You can buy it for 315 now. Sounds like a bad deal, but what could Oracle stock do? It could drop or it could shoot up, right? It just shot up here recently. What if it shot up to 350? Would you be glad you had the right to buy for 320 if it shot up to 350? Be pretty good. How much would you pay someone to be able to buy Oracle for 320 bucks over the next 4 months if it's currently trading for 315? Would that be worth $1, $2, $10? I don't know what the answer is, but I'm curious. If anyone can guess, Miles, can you do that math off the top of your head? It's kind of hard to do, isn't it? You say 5, that may not be too far off. Let's see. What did I say? 320? Oh, look at that. 32 bucks. That's pretty crazy, isn't it? You pay 32 bucks to buy a stock for 320 bucks. That's currently, did I get the right one? That is the call option, right? So 32 bucks, really, really expensive. Why? Because Oracle stock has been really, really volatile. So the market's saying there's a good chance they could shoot. They just shot up. You know, how much did they shoot up here dollar wise? They went from they're up 60 bucks just this month. So you see why it's so expensive. What if I take a more boring stock? The most boring stock I can think of. Did AT&T stock shoot up 60 bucks? That's $1 in the last month. All right. How much would you pay to buy AT&T for $32 in the next several months? That might be $5 or or 50 cents. Who knows? Let's go to December here. So for 32 bucks, we can't do 30. There it is, 28 cents. How's the market deciding that? Well, they're looking at how volatile that stock is, because if it's really volatile, I'm willing to pay more. If it's not really volatile, I don't need to pay as much. So are you going to run out and buy AT&T options for 28 cents? Seems pretty cheap, 32 bucks. But AT&T stock, I used to own AT&T stock and I watched it just sit there. It looked like the heart rate for someone who's passed away, just sideways, the most boring stock. I think it had a jump here not too long ago for some reason, but nothing too major. Yeah, it shot up, but look at that, just straight across. I mean, this looks like a big jump, but it's only about 8% or so. It's not like Oracle's 23% in one day or whatever. So that's the right to do something. when you do that, you pay a small premium, but if the stock takes off, you make a fortune. Because you think about AT&T, if it goes to 35 bucks, you get to buy for 32, you only paid 28 cents. So you could buy for 32, you can immediately turn around and sell it for 35 bucks. You make $3, you only paid 28 cents. That's a huge return. So options, they are very leveraged. They rise a lot when what do we call the thing that the options own? The underlying, when your underlying rises. So if AT&T stock goes up, that 28 cents you put in the option, that could go to $3 to $4 to $5, could rise really fast. So very, very leveraged. So a little bit of option gives you a lot of the upside of the market. And that's what we're looking for with the equity-linked annuity. We need something that we can invest in that doesn't cost us a lot, but if the stock market goes up, gives us a lot. If the stock market goes down, we don't lose much, but if it goes up, we make a bunch. That's essentially what we're trying to create. So if we look at this problem, let's walk through it and we'll just work it so before we run out of time so we can at least get through it. This is a single premium deferred equity-linked annuity. It's a product that's a little bizarre, but these do exist. In fact, equity-linked annuities tend to be single premium. So most people, when they buy them, they walk in with a lot of money all at once, like 200,000, 300,000 bucks. This person walked in with 200,000 bucks. And obviously they got that salesperson there pushing it because that person's going to get like a $20,000 commission off of this. But we're ignoring the commission. And we tell the person, if you buy this annuity, the worst you can do over the next 8 years is make 1.5% a year. That's the worst you can do. We're going to guarantee you that. All right. That guarantee is pretty important. This is an 8-year annuity. That's really important that you pick up that. I did this a long time ago. You can see where the S&P has been. It's at what, 6,700 or something today. Kind of crazy. So yeah, it's amazing how much the market's up. I must have done this during the 2008 crisis or something. The S&P got down to it got really close to like 666 because I remember that number. So it got really low during that time. So 1450. What does an at the money call option mean? It means you have the right to buy the S&P at a price of 1450. That's at the money. If you look at the options here, AT&T is currently trading at about $29. That $29, that would be between $28.50 and $29. That's right at the money. It's pretty close to the current strike. All right. So I tell you at the money, you can't come up in the exam and say, what does at the money mean? It means that your strike price is $14.50. You just have to know that. The current level is $14.50 and the options at the money, that means the option strike price is $14.50. All right, that's defined. The premium on that is $500. Now, some of y'all know when you buy options, you have to buy contracts that are 100 options each. Ignore all of that. That's not in this problem. And the life insurance company can also buy a zero coupon. Why zero coupon? That's just to make the problem easy. In real life, you wouldn't do that, but just to make the problem simple, a zero coupon. So the life insurance company can invest at 4.5%. They have to make sure they make at least 1.5% because that's what they have to pay to the policyholder no matter what. All right. So they're making 4.5%, but they only have to pay 1.5%, which means they've got a little extra money left over that they can do what? Buy call options with. All right. I'm going to say, I love this. This is one of those things, like with Primerica, I like buy term, invest the difference, but I don't like Primerica. Here, I actually like the idea of equity-linked annuity. I just don't like buying them from insurance companies. You're better off setting them up yourself on your own because I think it's a really good investment, especially if you have grandparents in their 60s or 70s. I think it's actually a pretty effective way to invest. So the first thing we got to do, we got 200,000 bucks. We're ignoring the commission and all that kind of stuff. You got 200,000 bucks. You need to invest enough of that 200,000 bucks to make sure When you invest at 4.5%, you've invested enough to guarantee that 1.5%. Okay. So how do you do that? So you need a future value and you need a present value. Now, Peyton, I don't know if you remember and Nathan, you're back there. Remember we did the catastrophe bonds? It's very similar to this. Remember the catastrophe bonds? You had to make sure you're going to give them their return. So it's a very similar one. So the future value is you got 200,000 bucks. And we have to make sure we make how much? We got to make at least 1.5% over 8 years. So we better have that much money at the end. It's great if we have more, but we can't have less. All right. So 200,000 bucks times 1.015, raise it to eighth. You might check this on your calculator. But I get, and you can round all you want to here. You can round down or up, I don't care. 225, 298, 225. All right. So we better have 225, 298 in 5 years. What are we going to invest today to get that? We're going to invest in a corporate bond at 4.5%. How much do we need to invest? Well, we need 225, 298 in the future. So remember, future value equals the present value times 1 plus the rate raised to time. The present value equals the future value divided by 1 plus the rate raised to the time. All right. So the future value was the present value, 200,000 bucks times our rate. The present value is going to be that future value, 225, 298 divided by, but this time we're going to invest at 4.5% raised to the 8. So 225, 298 divided by 1 plus 0.0, what was it, 45? Raised to the 8th. That's 158,426. Everybody agree with my numbers? Y'all double checking me on your Excel, on your calculators? You don't get Excel on the exam, so make sure you know how to do it on your calculator. I usually have at least one student with, okay, I borrowed my roommate's calculator. I don't know where the X of Y key is. So make sure you know where your X of Y key is and practice it. Don't do everything in Excel and then come an exam is like, oh man, I don't know where to do it. I had some students that, not a big deal on the first exam. On the second exam, make sure you know how to take it out enough decimal places. Some of y'all have decimal places, so test your calculator. Do it in class the way you're going to do it on the exam. All right, so this is pretty exciting because we received 200,000 bucks. We only need 158,000 of that to guarantee a 1.5% return. This is a strategy. It's a great strategy. You can tell your grandmother, you know, I can guarantee you 1.5%. And all I got to do is invest 158,000. You've got 200,000. I can take that extra 42,000. I can do whatever with it. I can go to Vegas and gamble it. I can put it all into one stock. I can invest in whatever. So it's a strategy. And whatever you do with it, what's your worst case scenario? You'll make 1.5%. All right. If you go to Vegas and lose it all, how much will your grandmother make? 1.5%. Right. Now, if you sell call options, that's a little different story, right? You can't do something where you can lose more than 100%. But as long as you do something where your worst case is you lose 100%, you know for sure she's going to end up with a 1.5% return at the end. So how much money do you have to play with? So you receive 200,000, but you only need to invest 158,426. So you have, oh man, I can't do this in my head. 41 of 574 maybe. Someone check my work. That look good? Okay, I can't do math when people are looking at me. So 41,000, and you really and truly can do anything you want to. So what is this product going to do? Well, it depends on what the product said. Is it tied to the S&P 500? Is it tied to the NASDAQ? Is it tied to the Dow? This product I talked about from my friend, it was tied both to the S&P and to the Dow. It's like, why'd you add an extra index in there? That's strange. I guess they thought it'd be good marketing. So how many options can they buy? Well, you have 41,574. Each option costs how much? $500. Plus 200 minus 158, 426. Take that divided by 500. And here you really do want to round. You can round up or down, but it's 83. I'm not going to say contracts. I'm going to say 83 options, because it gets really confusing. And when you buy options, an option contract is 100 options, but we're talking individual options here. So this is 83 options. You might say you can't buy 83, you have to buy 100. Well, the life insurance company has hundreds of customers. They'll work it out in the rounding. So they'll be able to work this out. So they'll get exactly 83 options. All right, questions up to there? Pretty cool strategy, isn't it? Especially today. Back in 2020, not so cool, because you're and bonds are making you 0.3%. But now the bonds are making 4 or 5% again. This is actually a strategy you could set up for someone who wants to take some risk, but they want to make sure they have at least a minimum return. Yeah, it's a pretty good strategy. All right, so the next thing you can do is you can fill out this table. Part of this table is really simple. The bond portfolio, you already know what it's going to be worth, because we can do the math, but we know it's going to be worth 225, 298. Right? Because you're going to invest 158, 426 at 4.5%. It's going to be worth 225, 298. You know you're going to have that. So that one you can just put in there. And that's true with all of them. So this is looking at, where is the S&P in 8 years? Did it drop? Did it stay the same, or did it go up? The bond doesn't matter. The only reason this bond is a problem is if it defaults. It is a corporate bond. It could default, but if it defaults, the insurance company takes all of that risk, and they have to eat that. So, right? How much is the call option worth? Well, my most popular YouTube of all time is this exact problem. So maybe that'll get me more clicks on this video. All I got to do is put the word option in a YouTube video, and suddenly everybody clicks on it. I don't know why that is. But the gain at expiration of a call option equals the max of the ending value, we'll call that S, minus the strike, and 0 times the number of options. That's the nice thing. Remember, an option is the right, but not the obligation. You don't have to execute the option. So if the S&P falls to 870, you don't have to buy the S&P for 1450. So 870 minus 1450, that's less than 0. So it's just 0. So if the S&P falls to 870, your options are worthless. You just let them expire worthless. You spent 41,574 at expiration. If the market's fallen, they're now worth 0. If the S&P is at the exact same level, 1450 minus 1450 is the same as 0. So there it's just worth 0. So here's the only one we have to do. We have to do the max of 2850 minus 1450 and 0 times 83. So equal max 2850 minus 1450 comma 0. How much is that? 1,400. You're going to make 1,400 on each option, and you got 83 of them. That's 116,200. So what's the annuity worth? Well, you just add across. Yeah. Okay. More math while y'all are watching. 341498. All right, I got it right. Okay, so that's how that looks. Then we're going to do returns. Again, don't memorize this formula. If you're a finance or actuarial student, if you don't know this formula, you're in a lot of trouble, right? There's a formula you should have learned your freshman or sophomore year. You didn't learn, but learn it now because every finance major, every actuarial major knows this. And that's the gain. It's also the CAGR. What is that formula? The ending value over the beginning value raised to 1 divided by n minus 1. I think I've used that formula more than any other formula in my life, probably millions of times in Excel spreadsheets. Pretty common. So we can do the first two, but we already know what the answer is. So on the, I'll do, they're the same numbers, 225, 298. How much does the person come in with? What's the beginning value? 200. Anybody guess what that's going to be if I raise it to the 1/8 power? You kind of already should know the answer on that one. Any guesses? What's their worst case scenario? 1.5. You better get 1.5, right? Isn't that just the backwards of this, right? They made 1.5%. So here they'll make 1.5%. Here 1.5%. So the only way we have to figure out is this one down here. $341, $498 divided by 200. Raised to the 1 divided by 8. This one. So 341, 498 divided by 200. Raised to the 1 divided by 8 minus 1. 6.92%. I did it right. Hopefully it's right. Hopefully someone's checking me here. And then the S&P, I'll do it real quickly. It's the exact same math. Remember the S&P started at 1450. So if we take 870 divided by 1450, raise that to 1 divided by 8 minus 1, we get minus 619, 0, and 881. So minus 6.19%, 0.00%, and 881%. Right. So on the downside, you made 150, where if you bought the stock market, you would have been down 6%. At the zero side, you make 150 versus you bought the stock and bought the stock market, you would have had 0. On the upside, you make 692. Now, if you could have won on the upside, you would never do this, right? If you could beat the stock market and cover the downside. So I have to make the problem so that these options are priced. They have to be priced so that you can't come out ahead. So if you get a higher number on the annuity on the upside, then you probably did something wrong. Let's work another one of these equilinked annuities. But before we did, remember last class, we filled in this table and I was trying to show you the graph. I just figured out how to do the XY graph with this. So this is the graph you're looking for. The red line or whatever color that is, orange, That's the stock market. If the stock market falls 6%, your portfolio falls 6%. If the stock market's up 8%, you're up 8%. It's just a straight line. This is the equity annuity. The reason I'm having you draw the graph is I want you to picture this hockey stick. It's a very, very famous structure where it's called bullish because it gains when the market's up, but you're protected on the downside. If you look at a call option, this is the picture of a call option. It's that hockey stick. It's a little bit different because you have a loss, but you can structure these. If it's structured that it protects you, but you do have a loss, then you get more upside. If you structure it so your worst case is a gain, you'll get less upside. So you can structure these all different ways, but essentially we use call options to create this. We use call options plus a bond. If you really look at this, there's something called put call parity. It's really, really famous. If you took my investment class, we talked about this. Put call parity is I don't want to do Investopedia, I want to do Wikipedia. What it says is that there is a synthetic way to create certain things. So it says a call plus a bond equals a put plus a stock. A call plus a bond. What is the bond? Remember, the call has a strike price. If you buy a bond that matures exactly at the strike price, that bond plus the call option looks a lot like a put option plus a stock. So there's a call option. If we do a protective put, it looks really, really similar, but they don't give us the graph. Long put, I don't see a protected put in here. See if this will give us a graph. No. I know there's a website that does it. I should have found it. Oh, you have to kind of take my word for it unless I can find one real quickly. Let me do this. Protective put graph. Surely come up. Right. So there's the protected put. Looks real similar, doesn't it? I love put call parity. What it's saying is the two sides of these equations are exactly the same. You buy a call and you have a bond that matures at the strike. It's just like buying the stock and buying a put option. They both have that hockey stick that goes up like that. If you just want to buy a stock, but you can't buy the stock, you can buy the call, have the bond, and sell the put, and it's exactly the same as buying the stock. I mean, exactly the same, which what that means is if you put the S over here and move the P over here, so that minus the P, and you price those two pieces, if they're not the exact same price, you have an arbitrage opportunity. You can buy one and sell the other, and you're guaranteed to have a profit at the end. There's no way you can lose money. Essentially, you invest zero and you make money. What's your return if you invest zero and you make money? It's an infinite return. I have something where this costs $20. These three cost $20 together, and this costs $22. You sell that for 22. You buy that for 20. You got $2 when it matures. We were zero. I mean, how much of that would you do? Would you do 1,000 shares of that? You know, you get $2 up front, and you know at the end it's going to be worth zero for absolute certainty. Would you do 1,000 shares of that? 10,000? How many would you do? A few trillion shares? You do whatever the market give you, right? So how often do these get mispriced? Practically never, because there's hedge funds out there looking for slivers of pennies to do this. 2008, when the market was in turmoil, you would actually see some trades like this look pretty interesting. And then you try to execute, you think, wow, I'm going to make a fortune. And you discover that the bid ask is so wide, you get killed on the pricing. It's not actually there. But if you're not familiar with put call parity, you should really look it up. That's essentially what we're doing here. We could do this with a call option, or we could have done this. So we did it with a call option and a bond, right? Y'all remember that? We bought a bond that matured exactly to give us that 1.5% return, and we put a call option on top of it. The other way they could have done this is they could have bought the stock market and they could have bought a put option underneath. The put option protects you if the market falls. So there's a couple ways you can create this, and this is the standard way of doing it. You buy the bond so you can guarantee yourself that return, and then use the call option to get you that upside. It's a very popular strategy. So here's how I wanted you to put the graph on your exam. It's the comparing these, and the reason I'm doing it, so if you know the reason I'm doing it, is I want to make sure you see this hockey stick versus this. What do you notice? First of all, the hockey stick wins 2 out of 3 times, but it cannot win 3 out of 3 times, or you would never do the orange line. Right? So you get the downside protection, but on the upside, you have to give up something. There has to be some give up. So I make sure to price the option such that you can't be better on the upside. So if you do better on all 3, then you did something wrong, because I'm going to make sure the option's priced correctly. But it's a really good strategy. It's a strategy I think makes a lot of sense, especially in 2020. In 2020, I probably would have bought the stock market and bought put options, because in 2020, this bond would have made no sense at all, because interest rates were so low. When interest rates are low, that's when I'll buy the stock and buy the put option. But right now, when interest rates are pretty high, buying the bond, locking in that 1.5%, and then buying a call option can be a really good strategy. It's probably the strategy your grandparents or great parents should be following, because it's a pretty decent strategy. So try to give me a good graph. Some students, man, it's like, I mean, if you want to bring graphing paper, you can, but make it decent looking. But you know why I want you to draw the graph, right? You see where the points are. So make sure the graph is showing me the hockey stick, and that it underperforms in one spot and outperforms in 2. That's the real goal here. All right. Any questions on the graph? We'll draw another one with the second problem. So if you get the steps, step 1, figure out how much you need at the end of the term to lock in that 1.5%. Take the present value of that to figure out how much bond you're going to buy today. The difference between that and how much money you received, that's how much you can buy in call options. Then you just do the table. All right. It's 4 pretty simple steps. And if you forgot the steps, that's what the questions are. All right. Step 1, you got to get the future value so that you can figure out the present value. Step 2, figure out how many call options you have. And then the last one, just complete the table. So you just follow the problem. What would the exam question look like? This is the exam question, except for the numbers. I will change the numbers. I tell students, there's a class I took. When I study for an exam like this, I actually memorize one question. So that if something happens on the exam, I forget something, I can just work that problem, get the answer, and make sure I have it right. So I did that in this class, and guess what the question was? It was the question I had memorized. So I already knew the answer before I even worked it. It was the exact same problem. I won't do that. You won't get the exact same problem. It will look very, very much like this. So let's work a second one. It's 1.5% again, but it's a $400,000, and the zero coupon's only making 3.8%. I did it a little bit later, so the S&P's up to 3,800. Today it was, I think, we've fallen off the last few days. Y'all been following markets? If you come to our dashboard team, you'll be really ready for interviews, because we talk about this. But the S&P is 66. It got up. It looked like it was going to hit 67. I don't think it ever hit 60. Well, it may have hit 67. Well, close. It got up to 6699.52. So we haven't quite hit 6,700. Where's gold right now? Anybody know? What's the first number in gold? 3. What's the second number? I don't think it's gotten that high. We can look. I haven't looked at it today. I guess it's possible. 3779. So it hit 3,500 for the first time ever 3 weeks ago. Then it hit 3,600 for the first time over 2 weeks ago. Then it hit 3,700 for the first time ever. Why in the world is gold hitting all-time highs at the same time the stock market's hitting all-time highs? Aren't they supposed to be going in opposite directions? Isn't one hedging the other? What do you think's driving gold this year? The declining dollar. This last week, the dollar strengthened a little bit and gold still went up, but over this year, this is the third worst year for the dollar, and gold's having its record run. Why does the dollar weak this year? Interest rates are dropping. Y'all learn all that in money and banking, right? Gold loves what? A weak dollar, low interest rates, political unrest, those type of things, inflation, loves all those kind of things. So it's a really good year for gold, but for some reason, the stock market's also doing well. So it's a strange year. It's almost like if you're losing money this year, you're not trying. I mean, you're trying not to make money because it's like an easy year to make money, which means we'll probably have a crash here pretty soon. Any of y'all TikTok users? You might be saved there. All right. So 3,800 now looks like gold prices, but back when I wrote this, it was the S&P 500. So what we'll do is I'm going to work this one. And then this weekend, hopefully I remember this weekend, I will send you the test question from the last exam and we'll work that next Tuesday. So you'll get some practice with that. All right. All right. Make sure you have something to take notes with and you're working the problem, or at least pretend like you're taking notes. All right. So someone walks in with 400,000 bucks. You're going to put some of that money or most of that money into a bond making 3.8. So the first question is, how much are you going to put into that bond? So remember, the first thing you do is calculate the future value. Then you calculate the present value. The future value is also always going to be some dollar amount times 1 plus a rate raised to some time, right? Future value is times. So what's our dollar amount here? 400,000. What's our rate here? How much? 1.5. Yeah. So here we're looking at the guaranteed rate. So remember what question you're asking. It's not what's in the question here. The question is asking how much bond to buy. But before you answer the question, you have to figure out how much do I need at the end of the term to defease this guaranteed. So we need to make 1.5% for 10 years. So we raise it to the 10. Try it out on your calculator. Make sure you have it down. And I get, remember you can round. So I get 464, 216. Confirm if that's not right, if anyone gets something different. That's your future value. So the present value is going to be a dollar amount divided by 1 plus a rate raised to the n. So here our future value is 464, 216. We're going to divide by what rate do we use now? 3.8. Yep. Raised to the 10th. And you know it's going to come in lower than 400,000. You did something wrong because we have to have extra money here. So I get here, you can round it up, 319,703. And that is the answer here. You need to put 319,703 into this bond. If you do that and invest at 3.8%, when it matures, it will be worth 464,216, which is exactly what you need to make the 1.5%. So we know no matter what happens, we'll make 1.5% as long as we invest the remainder of the money in something that can't lose us more than 100%. We can lose 100%. If we lose 100%, we'll make exactly 1.5%. So do mark what your answer is on the second one. Don't do all the math and don't tell me what the answer is. It's that one right there. So the next one has two parts to it. How many options can we buy? So let's first figure out the amount to spend. It's going to equal the 400,000 that they gave us minus the 319,703 that we're going to have to put into the bond. So that's probably going to give us something like 80,297 or something. Don't trust, wait, I can't do that in my head. 8297, is that what I said? All right, so 8297. And again, you can round everything to dollars. So the number, don't say contracts, it's the number of options. It gets real confusing. Contracts is, each contract has 100 options. We're completely ignoring that. So here we have 80,297 in dollars. This is dollars. Each contract costs how much? 940. So we divide by 940. And I'm going to say 85. You can say 85 or 86. Either one is fine. 85 options, not contracts, 85 options. And that's the question there, is how many options are you going to buy? Everybody's good up to there? It is a fairly straightforward question. Then we answer the question here, the table. Well, I don't need that. So we know if the market is, so 3,800 is a strike. How do we know that? Because this is an at the money option. At the money means that the strike is the same as where the market is today. So if the market closes at today's level or any lower, you know you're not going to get anything out of the options. So let's put the numbers in here. What's your bond portfolio going to be worth when the market's up or down? I mean, that 464,216. Doesn't matter what the market's doing, you're going to get that. And I've already forgotten the number. 64,216. So that one's very straightforward. The option portfolio is going to be 0. Because you remember the gain on the options equals, these are call options. The form is a little bit different with the put option, but on call option, it's the max of the stock minus the strike and 0 times the number of options. Here we're taking 975 minus 3,800. That gives us a negative number, so it's just 0. 0 times the number of options is 0. Here we're taking 3,800 minus 3,800. That's 0. 0 or 0 is the max, doesn't matter. So the only one we have to do is the very last one. It's going to be the max of 12,900 minus 3,800 and 0 times 85. You get 773,500. It sounds like a really massive number, but when you compound something over 10 years at a high return, you get a massive, massive number. Hopefully I did it right. Then you just add across 464, 216, 464, 216. Oh my word, I can't, now I'm not getting try. So 773,500 plus 464, 216. 123. 7716 or something. 7716. 123 7716. Anybody can confirm any of those? Yeah, doing it in Excel. Make sure if you do it in Excel, you can also do it on a calculator.
Are there restrictions on calculators? So
No, I just don't have any formulas saved, but no, I actually prefer scientific over financial, but yeah, I hate financial calculators, but yeah, I mean they can be nice, but make sure you have an exponent key that's working. And then return is a formula everybody should know in finance, actuarial science, doesn't matter. You're taking your ending value divided by beginning value, raise it to the 1 over n minus 1. It's a CAGR, just like you do a CAGR, compound annual growth rate. So on these, the first two is pretty straightforward because you have 464, 216 divided by 400,000. We already know what the answer is, but we can still do it if we want to. Raise that to the 1 divided by 10 minus 1. We better get 1.5%. If we don't get 1.5%, we did something wrong. Because we know your worst case scenario is 1.5%. So we just have to calculate this last one plus 1237716 divided by 400,000. Raised to 1 divided by 10 minus 1. And we get 11. If you can go out 2 decimal places on the returns, 1196. And then we do the S&P the same way. So plus 975 divided by 3,800 raised to the 1 divided by 10 minus 1. This one we know is 0%, and then plus 12,900 divided by 3,800 raised to the 1 divided by 10 minus 1. So 13%. 1272. And you feel pretty good because you were better on the 2 weak markets and you were worse on the best market. That's essentially what you're looking for. Questions on this? Some students who struggle in this. This is the part you should have known coming into the class because you should have done this like a million times. You'll do this a lot in your life. So what we got to do is just do the graph. So we got 1.5%. So here are the market. So all you do is get this last one here, 1196. It looks exactly the same, right? It's the same structure. You see the hockey stick, and then you see that the market outperforms at the top. So make sure you have a graph that looks like that. Again, if you want to bring in graphing paper, that may help, or just draw real carefully. Some students are a little weird in the points they pick, like they go from 0% to 50% or something, but or negative 100%. Start your graph where the S&P or the market is, end it where the market is, so that your graph fills in all the spaces. So there's the graph. See if I can get that in there. right? That is the question. I really think everybody should get 100 on it. I'm still waiting for the first class where everybody gets 100 on this because it really is straightforward. Um, so just practice. You've got a few more to practice with, including the first one that has the YouTube video with it. And then we'll do one more on Tuesday where you'll work it in advance. If anyone wants to volunteer to work it for the class, that'd be great. If anyone does, I'll offer them 10,000 bucks for doing it, unless I change my mind later. So, all right. Any questions on that? It's a pretty cool product, right? It's pretty cool unless what? You buy it from an insurance company. Then it's not. Why? Because they got to take a lot of fees out. So if you create it yourself, it's a really cool product. If you use an insurance company to do it, remember they're subtracting tremendous amounts. The first thing to remember is if the commission's 10%, they're starting off without 40,000 bucks. Is there any chance? You always have to think, is any way life insurance company can make this a great product? If you give them 400,000 bucks, they give the sales rep 40,000 and they only have 360,000 of your money. Is there any way they can do better than what you can do yourself? It's mathematically impossible. You got to know how to do it, but if you know how to do it, you can see you can do this yourself far, far, far better. Now, the insurance company does have an advantage from a tax standpoint. How do you make up the tax problem with the insurance company? What do you do? Stick this whole thing inside of what? In your Roth IRA, right? If you do this in your Roth, then you don't have to worry about the tax side of it. So, there's things you can do. We did some pretty cool stuff at USA in the pension plan because the pension plans are tax-free within the pension plan. And you take the taxes out, these get really pretty good. If you have a Roth 401, a Roth IRA, you can do these type of transactions pretty well. The IRS is very mean to option traders. So if you do this outside of a tax advantage security, it can be bad for taxes. So the life insurance industry does have a little bit of advantage, but it's almost impossible for that advantage to offset the costs and commissions you're having to pay up front on the product. So it's a great product, poorly designed, poorly executed. All right, let's jump back to the class notes. Oh, that's the wrong class. All right, so let's talk a little bit more about annuities. Very, very important on annuities that you distinguish two periods of time: accumulation and payout. Most of you, when you hear the word annuity, you think about your finance classes. Annuity is a fixed payment over time. So you think of that as an annuity. So it's a payout. We think of it as a payout product, but the insurance industry uses the word annuity to include you're investing to build up money so you can create an annuity. So you have the accumulation period, which you're saving the money. Then you have the payout period. Life insurance companies offer these. Investment companies have these. You can buy IRAs, Roth IRAs from investment companies. Those are accumulation products. Banks have these products. They're really very, very much doing the exact same thing on the accumulation side. Life insurance does have a little bit of they do offer a little bit of life insurance related annuities, but it's a small part of the product. We'll talk about how Hartford Life almost went insolvent because of that piece of it. It can be material, but for the most part on the accumulation side, the biggest difference is taxes. The life insurance industry does have some tax advantages over banks and investment companies. On the payout, that's where the life insurance industry has its huge advantage because they can do things that are life contingent that banks and investment firms cannot do. Now, the federal government can, right? They have Social Security, that's life contingent, but outside of life insurance, private firms can't do life contingent products. If a bank does a payout, they're going to pay out, and if the person dies, they'll keep paying out to their dependents. They can't do something that's dependent on when the person dies. So if the person dies, they keep paying out, it just goes to the estate of the person. Life insurance, though, can say, hey, as soon as this person dies, we stop paying. That's unique to the life insurance industry. That is a payout annuity. What does the insurance industry sell most of? Accumulation products or payout products? Well, first, which should they sell the most of? Where do they have the advantage? We just said that, right? Where do they have an advantage? Accumulation or payout? Payout. What do they sell the most of? Accumulation, because what do they want to do? They want to be asset gatherers. So I've talked to experts as why are y'all selling payout annuities? Oh, we just don't make much money on them. They're kind of boring products. Yeah, but that's your huge industry advantage. It's like, yeah, we just don't. You used to be selling a bunch of these, right? We got all these baby boomers retiring. This should be your product. Yeah. Last time I talked, I spoke to UTSA alum about this, and yeah, they're starting to sell more of those, but you can tell they're not really excited about it. It's kind of an accommodation product. That should be their focus because in this world, they really have very, very little advantage over the other. In fact, they have a disadvantage because their costs are much higher. Remember that? So payouts what they should be doing. People are living much longer. And so the payout with life contingency is a way to protect people from living too long. People are technically retiring earlier, and we got the baby boomers. So this is all your paper one. That third article is talking about that. Those are big issues. What can you do? You can retire later, which is what a lot of people are going to have to do, or die faster. I don't know which, you can put into your plans. Social Security is certainly doing that, but your generation is worried if there's going to be any money left for you, and that's a legitimate question, although I think Medicare is a much bigger problem. So annuities is a good way to address this. You can retain it yourself. That is, just build such a massive portfolio, you can't possibly outlive it, but what does that mean is you spend your whole life saving, and then you don't get to spend it because you're worried you're going to live too long. I mean, is your goal to die with as much money as possible? What do you want to do? You want to be down to your last penny the second before you die, right? But if you try to retain it, you're going to have to retain a massive amount. So remember with the annuities, the advantage is you get to freely spend your entire portfolio. You won't have to worry about it. Why? Because the insurance company takes that longevity risk. They keep paying you even after your money's run out. So this is your Article 3. It's an important part of that article. Or you do nothing, you just assume, hey, there's no way the government's going to make me live out in the streets. And that's somewhat true with Social Security and Medicare. If you really take yourself down to poverty, there are programs that will step in. They're not going to give you a lot of money, but they'll step in and maybe keep you from complete disaster. But the life insurance industry should be playing a much more important role in this than they are. So Social Security, this is your Article 3 on paper 1. Social Security was not set up really well. It's set up as pay as you go. And so with the baby boomers all retire, it's probably going to devastate that. I wrote a paper on Social Security in my graduate school, and I found a very interesting quote from Franklin Roosevelt, who was the president who signed the Social Security bill. And it was like the last page of this book he wrote. He says, if you make Social Security pay as you go, it will be bankrupt by 1980. And sure enough, in 1980, it was bankrupt. And President Reagan and Tipper O'Neill, they got together to save Social Security. And what did they do? What happened in 1980? Well, recessions, but what happened related to taxes? So everybody talks about Reagan cutting taxes, but Reagan with Social Security, he and Tip O'Neill, they significantly increased payroll taxes. Income taxes, yeah, they kind of came down, although the rich probably paid more because they got rid of some of the special deductions. But for the general public, taxes went up a bunch in the 80s on the payroll side. I don't remember what it was. We might be able to find this. It would be an interesting thing to add into your paper. So yeah, yeah, we should go look at it. They greatly increased it in those years, but you could probably find it somewhere in here. Um, So yeah, it went from 5% to 6.2. That's like a 20% increase. And in Medicare, oh wait, and it's self-employed. Boy, I learned that. I don't know if you've ever been self-employed, but you get your first paycheck self-employed, you're like, wait, where'd all my money go? Because you have to pay your portion of Social Security and the employer's portion. Um, so yeah, it's pretty hefty. So yeah, pretty hefty increase in that year. So they did save Social Security in that year, but we're back to now. You don't hear Social Security as much now because Medicare is a much bigger problem. It's much more bankrupt than Social Security, but it's still an issue. If I were you, should you plan for some Social Security? There'll probably be something there, but you might not plan for the entire amount. And then you have pension plans. You talked about this in Article 3. Pension plans are going away. Pension plans are declining where 401k is going up. And then what are employees doing? They're spending their 401k plan. They're not investing the amount that they should, or they're borrowing against it. So we're setting up quite a disaster. What is the savings of a typical 50-year-old US? I don't know if they give you that number. I don't think they give us the median. They say the average is 240 to 245, but the average is meaningless because it's not a normal distribution. It's extremely skewed. So we want the median. I don't see the median in here, but somewhere they'll give us the median. They say that's the salary. So it's not much. Huh? The word median?
Yeah.
Most articles give both because it is a pretty interesting word. Yeah, that one doesn't answer it. I've seen articles and it is out there, but and you get different answers every single article, so you can't really be sure how much each generation currently has in savings. I don't know what these percents mean. So anyway, but it's out there. It's a small number. It's not enough to retire on. Oh, sorry. Or the graph. The graph is showing you the percentage of corporations provide a 401k versus the percentage that provide a pension plan. So they're switching, but yeah, so you're not getting as much. So you should definitely load up in your 401k plan and don't even look at that money. Just let it build, get the matching from your employer because you're going to have to do this yourself. Your personal savings, but life insurance really is the one product that should be sold more because it does keep paying no matter how long you live. So you have the accumulation side. The life insurance industry has the same tax advantages that banks and investment firms have. Plus, they have an additional, you can defer more with life insurance than you can with these other plans. They do have some special advantages. And then on the payout side, a life annuity, it just pays out until you die. You can give it a period certain, so you can say, hey, you know what? I want this to pay out until I die, but if I die in 1 month, make sure it pays out at least 10 years to my heirs, because I don't want to give you $500,000 and then I die 1 month into this thing. But if you do that, if you have the period certain, it's going to reduce how much your monthly income is because they can't give you that 10-year guarantee without reducing some of what they pay you. This next one is not really covered all that most. So any guarantee you put in there, if you have a guarantee for how long it pays you, I know the third article talks about inflation-linked annuities. They just really are very, very, very difficult to design. They're probably a little more likely today. We may talk about this some, maybe a little later. I'll talk about it more in my property casualty class. But for the longest time, inflation-linked bonds had just horrible, horrible yields. They were negative yields. So that was just terrible investments. Today, they're a little more normal. You can have a minimum rate guarantee on it. That's on the deferred annuity, but anything you do that enhances it is going to reduce reduce the product in some way. The annuitant, that's the person whose life governs the annuity. When that person dies, that's the annuitant. You can have the annuitant, but you can also have the person receiving the payments. So you have the beneficiary. So the beneficiary and annuitant can be different people, but the annuitant is the person whose lives. There is some anti-selection on annuities. Actuaries assume if you buy an annuity that you're expected, and we're talking about a payout annuity, you're expected to live longer. And so they actually use different mortality tables for people who buy annuities than people who buy life insurance. Which brought up a question. You actuaries, maybe one of y'all will answer this question. I haven't gotten an actuary to answer this yet. But if you buy life insurance, you're assumed to be less healthy than average. So premium is higher. If you buy an immediate annuity, you're assumed to be more healthy than average. So the payout is lower. So they just assume people who buy life insurance are likely to die earlier, so we're going to charge them a higher premium. People who buy immediate annuities are healthier, so they're going to live longer, so we're going to give them a lower payout. So my question to the actuaries is, what if someone buys both products? Aren't we cheating them? And my answer from actuaries is they shrug their shoulders. So it's like, yeah, probably so, but we're not going to change it. But my argument is, hey, if someone buys both products, you should give them some kind of premium benefit because they can't both live longer than expected and die early at the same time. This is not possible. And there are people who do buy both. I mean, there's no question. People who buy both, they have life insurance with the company, but also buy an immediate annuity. We should probably give them some kind of break on it. But that's the assumption, and it's in the mortality tables. They have different mortality tables for annuities than they do for life insurance. So for annuities, people who die early, and I'll show you this later when we did a longevity product, people who die early subsidize people who live very, very long, the exact opposite of life insurance. Now, when you work for a life insurance company, annuities can get a little tricky because they classify them different ways depending on who the audience is. And we'll see that in this list. So annuities can be an individual or group. An individual is one that you go buy for yourself. A group is one that your employer provides to you as part of a group, what we call a group product. We'll look at group insurance a little bit later. As we saw earlier with life insurance, there are variable annuities. So annuities can be fixed. That just means it pays you an interest rate every month. Has to be positive. You can't really have a negative return. The company takes the investment risk. So if the company buys a corporate bond at 6% and they pay you 4.5%, if that bond goes default, you don't take that risk. The insurance company does. So on the fixed annuity, the insurance company takes the investment risk. Your risk is to the insurance company. If they go insolvent, then you're in trouble. For variable products, the policyholder takes the investment risk, but you're not exposed to the insurance company because they have those assets parsoned off. But although there is some debate, if you have a variable product and your life insurance company goes insolvent, there's a chance that the creditors of that company are going to try to get your money from your variable products. But the argument is those should be safe from the creditors. So the fixed annuity, you don't take the investment risk, you take the risk of the insurer going insolvent. The variable annuity, you take all the investment risk, but you're not concerned about the insurance company. Variable products, just like on the life insurance side, they're regulated by both the states and the federal government. They're considered to be investments. Anytime you see that word variable. Variable products do provide a death benefit. And this is what caused Hartford almost to go insolvent in 2008. I don't know if I can show you there. Y'all have heard of Hartford, I guess, probably. I cannot remember their ticker. It's a strange ticker. Yeah, I still don't see it. I still don't see it. Maybe they did go out of business. Hartford. Yeah, that's not it. There it is, HIG. Did I misspell it? Didn't I spell it right? All right, Hartford, let's go back. Do y'all see 2008 in there? That's a pretty good drop, right? From $106 to $3 to $6. So it went from it dropped from 106 to $6. Why did it do that? Hartford is a property and casualty insurer. They do auto insurance, home insurance. But this was caused by their little bitty life insurance company. So what did they do? It's really, really interesting here. They had variable annuities. And what they said is if you at death, you get your estate gets these are accumulation products. So I should have made that clear. When you're talking about fixed versus variable, we're talking about the accumulation stage, not the payout stage. So if you at death, your estate gets the policy value or premiums paid if lower. What happened in 2008? Stock market crashed. So the premiums paid were higher than the policy value. So people invested 200,000 bucks or whatever. The stock market fell 30%. So they're down. They paid 200,000, but they lost 60,000 bucks. So if they die, their policy amount is 130,000 bucks. But the insurance company says, yeah, but if you die, we have to give you your $200,000 back. And so what happened with the accounting, since the stock market fell so much, Hartford they had to set up reserves for potential life insurance payouts. Why? Because all these accounts are below the initial premium. So they had to set up this mass reserve because you don't know when the stock market's going to come back. As far as you know, if these people die next 5 years, you're going to have to pay them back that 200,000 bucks. You can't just pay them back the 130,000. So Hartford had to set up this massive reserve in their life insurance company, and it just freaked the stock market out. They weren't really sure what that meant. Now, since then, it's not been a problem, right? Because the stock market came back and not that many people died with the annuities, but it just freaked the market. And how much did it freak the market out? About $100 on 100. And, that's like a 90% drop. And that's not a very, very long time. That's 2007. That's like a year and a half. That stock dropped 90% just real quickly. Where do you wish you had bought Hartford stock? This wouldn't have been a bad spot, right? $6 and now it's 131 bucks. That's over 15 years. Maybe it's not that great. Plus 130 divided by 6, plus that raised to 1 over 15 minus 1. Does that look familiar? So 23% return. Do you wish you bought Hartford in 2009? Would have been pretty good return. Probably would have beaten the stock market. You might not have beaten Nvidia, but so this can be important. Generally, insurance companies find this death benefit to be very, very, very inconsequential. But in a year like 2008, it can be quite material. All right, so fixed versus variable. This really only applies to the accumulation stage, not the payout stage. So here's how you distinguish between the payout and the accumulation. The payout stage, they're called immediate annuities. The accumulation stage are called deferred annuities. So deferred means you'll get an annuity, but right now you're just building up your investment. You don't have to annuitize the annuity that you bought. So if you have an accumulation annuity, You don't have to take the annuity from there. You can move that money somewhere else and in the payout start taking money from there. Annuities can also be single premium or installment based. So there's a really famous annuity called an SPDA. That's a single premium deferred annuity. So it's an accumulation product. You walk in with 200,000 bucks, put it in an annuity, and they're going to just save it for you for several years. A SPIA, which is what insurance companies should be selling today, is a single premium immediate annuity. And generally what happens there, you have a husband and wife. One of the spouses dies and the other one gets a big life insurance payout. They take that life insurance and put it into an immediate annuity. So it's a single premium because they're using life insurance to buy the annuity. So SPIA. So you got SPDA and SPIA. Those are two pretty popular products. And then you have installment, which means you're just going to invest $50 a month, $100 a month into an annuity, and that's going to be an installment. Those are always going to be deferred accumulation products. There are single annuities, which is the most common, but you can have a joint life annuity. It might pay until the first person dies, or it might pay when the second person dies. It can be either way. You have pure life annuities. What that means is once the person dies, it stops. Whether it's one day later or 50 years later, that's a pure life versus we talked earlier, period certain, where you want to make sure, hey, I want to make sure at least I get a certain amount of money back. And you can't even have a refund feature. It says it keeps paying until it pays out at least equal what you paid in. But any bell or whistle you put on it, it's going to reduce how much you're going to get out of the product. The next one is really not a type of annuity. It's more of from a buyer standpoint, this is more from the insurance company side, although you'll notice it as a buyer. It's a market value adjusted annuity. And what happens here, we talk about disintermediation, where people are taking their money out because interest rates have risen. They can get their money out of annuity and go over to a bank at a higher rate. Or what a market value adjusted annuity says is, hey, if you surrender your policy because interest rates are really high, you want to go somewhere else, the insurance company gets to charge you a penalty because of the higher rates. So it protects the insurance company from disintermediation. Usually the customer doesn't like this. The insurance company loves it. They can generally pay more aggressive rates, so it can be a more competitive product, but usually the buyer doesn't like that. But if you're pretty sure you're not going to get out of the product, you want to stick with it forever, then having it be a market adjusted annuity, you'll probably get a higher return on it because the insurance company can be a little more aggressive. Some of the things defining annuities is related more to the IRS than to the customer or to the insurance company. So qualified versus non-qualified just really means what is the tax treatment. So qualified annuity, you get a tax deduction for investing in it. That's a traditional IRA. But when you take the money out, you're going to be paying tax when you take the money out. So you get a tax deduction today, then you have to pay tax in the future. Non-qualified just doesn't have that tax advantage. Most of you are probably going to do Roth IRAs and Roth 401ks. You don't get any tax deduction today, but then supposedly it's tax-free for your entire life. I really question that. There's nothing that keeps Congress from taxing this thing 20 years out when they're desperate for money. But right now, the tax law says Roth IRAs are tax-free. I've got a Roth IRA. I set it up after I retired from USAA because USA's 401k was too big to let me have a Roth IRA, but I do have a Roth now. I'm assuming it'll be tax-free the rest of my life, but who knows what they'll do. We have a pretty big deficit. I did go out and look at US holding of gold. So we have a 30-something, what is our US debt? $37 trillion. That's $100,000 per person. That's not counting Medicare. Medicare is another 30 to $100 trillion. So my question was, if you take all the gold, because gold prices are up, how much does that reduce it? I'm going to told y'all this last class. That's like $1 trillion. So So it's really not $37 trillion. It's really only like $36 trillion. And I don't know how much the land and buildings the US government owns is worth. So that's $100,000 per person. And you throw Social Security on, I mean, Social Security and Medicare on top of that, you double or triple that number. So essentially, you're going to graduate from college with about a $250,000 debt that my generation is handing over to you when we pass the reins. So I wouldn't trust this as always being tax free. At some point, they'll probably start taxing it. They started taxing Social Security when they said they wouldn't. So they're going to have to get some taxes from somewhere. And that's why it's really hard to decide if do I do traditional IRA or Roth. You don't know what future tax rates are going to be. You don't know what the Roth IRA. Most people say do the Roth because tax rates are going to be a lot higher in the future than they are today because of all that debt. But you don't know even if Roth will be tax free. Your employer probably does provide a Roth 401k. You should really look into that. That could be really, really good. You don't get the great tax deduction today, but when you start out, you have your lowest income, right? So you don't need tax deductions today. You want to be tax free in the future. So you assume your tax rate will be higher in the future, but who knows? You can't really run scenarios on this because you'd have to figure out what future Congresses are going to do. So it would be tough. You can ask ChatGPT what they're saying. I don't know what it would tell you. All right, so, and then the last kind are what we talked about last class, equilinked annuities. It was at the time I did these notes the fastest growing segment. I doubt it's true today because most people I know that have one of these and have had it for a few years are really disappointed. And you know why? We saw it last class, right? You're seeing the stock market up a bunch and their equilinked annuity is only up 5-6%. And they're like, what's going on here? I don't understand it. So they're not as popular. These equilinked annuities really show that the insurance industry is getting further and further away from the actuarial department. That's when I think insurance is out of its league. Anytime you don't need an actuary, you're probably in the wrong business as an insurer because that is their bread and butter. It's actuarial science. That's what insurance is all about. You start offering these products where you don't need an actuary at all. It's just an investment product. The only way you can get this to work is you're going to have to hide behind the complexity and with the hard sell because you just cannot compete. But equity-linked annuities are not regulated by the SEC. I think they should be. They look like investment products to me. But the SEC, they were going to. It was really, really close. There was actually a bill before Congress to make these regulated by the SEC. And the insurance industry fought hard. Why? Because they're really profitable to the insurance company. They're really profitable to the sales agent, which means they can't possibly be good for the customer. But the insurance industry won. So the insurance industry argues we provide some guarantees, but you see the guarantees, they're just using the option market to provide the guarantee. They're not taking any risks. They're just passing on what the market gives them. And I think the biggest thing that probably make these an investment is the way they're sold. They're sold as investments. They're not sold as insurance. The way they're marketed. You hear a lot. You get the returns of the stock market without the risk, which is absolutely not the true, but that's the way they're sold. They're sold as an investment product. We talked about the participation rate. You could advertise 100% participation rate. Sounds a lot better than 50 when it's actually worse than 50. And it's just really complicated. So how does the SEC decide if they're going to regulate an insurance product as a security? And there's a Rule 151 safe harbor that says, hey, if you fall under this rule, you're insurance, you're not an investment, you're safe. So what the SEC looks at is the company regulated as an insurance company? And that's true for all equilinked annuities. So they meet that rule. You don't have to worry about that. You cannot sell an equilinked annuity if you're not a life insurance company. So that's covered. Requirement 2, there must be some allocation investment risk to the insurance company. You can't just go out and buy an investment and pass that entirely on to the policyholder. You can't hold it in a separate account so you can keep track of it. There should be guarantees and they can't just be token guarantees. This one's pretty questionable because the insurance company is going to set up these ELAs to make them as safe to the insurance company as possible. They're obviously not going to take stock market risks. They don't have enough net worth to do that. So insurance companies argue we do provide some guarantees, but they're pretty minimal on these products. The third requirement, I think, is the one that really gets the SEC really looked at the hardest, is how are they marketed? And they're definitely marketed as an investment, not as insurance. Now, this rule isn't hard and fast. This gives the SEC some options. They look at your distribution channels, what words you're using, how the company's sales force is trained. They can look at it and say it's marketed as an investment, but we still want regulated. That one's a little iffy, but that one, I don't think there's any question these are being sold as investments. And then the last one is there any mortality risk? That also is not an actual rule, but these may have a little bit of mortality protection, similar to the other annuities, that if the market's down or something, but it's pretty material to this product. I think requirement 2 and 3 make this equity-linked annuities definitely an investment, but it just shows you the power of this industry. It fought hard, and it won a very close battle. Should you buy one of these products? So my answer, but one of y'all get into a sales pitch for this and record the whole thing and send it to me. I'd really love to hear it. You may have to, well, you can't put it on YouTube. Maybe if you don't tell them you're recording it. And then like right at the end of the conversation, say, oh, wait just a second. My brother works for the insurance commissioner and my other brother works for the SEC. Can they come in and listen to this and just see if they change their pitch? Would be interesting. It does worry me, this industry, because it's relying on sales commission agents, and they're selling this in people's living rooms without any scrutiny. It does worry me what these people are saying in those meetings. So boy, I wish I had recordings of these presentations. All right, tax treatment. Annuities do have some advantages. So the Pension Reform Act is trying to help people who don't have a traditional qualified plan through their employer, or they can't do a Roth or something. So the insurance industry does get some advantages. Traditional IRA, these rules are probably changed here recently. I think I was able to put 7,500 in. Because after a certain age, or 8,000 maybe. So, but they're pretty restricted. But you get some in. Life insurance companies, they can't give you more tax deduction, but you can put more in that's tax deferred. So you do get a large amount that's tax deferred. The distributions are taxed, but you do get tax deferral for many years, which is quite nice. The problem with the tax deferral is anytime the IRS giveth, they like to take away. So there is a penalty if you take your money out too early, 10% penalty. And then you have to start taking your money out at 70. We talked about that with Donia, and how her sales rep didn't know how to do that. Once you turn 70, if you don't take the money out, you're still taxed on it. So essentially what they do, and you can see in the IRS tables, they essentially assume you're going to live a certain number of years. And so you have to take out enough. So if you're going to live another 16 years, you essentially have to take 1/16 out. And that kind of changes over time. And then that's what's going to be taxed. All right, we talked about Roth. The nice thing about these investments is that you can put just about anything into these IRAs. You can't put life insurance into them, but you probably wouldn't want to do that anyway, because life insurance already has an advantage. You can roll these over sometimes. Like my pension plan at UTSA, I rolled it over into a tax advantage security. I'll still have to take it out when I turn 70, but at least I kept getting the tax deferral. That's the largest check I've ever personally cashed. I was like driving, like, I hope I don't wreck on the way. I asked USA if do you have to do a check? You can't wire this over. It's like, no, it has to be a check. And you're gonna mail it to me in the mail? Yeah. It's like, oh, I can't drive over and pick it up. So I was like really nervous. I drove very, very carefully over. Please don't wreck my car. Um, so yeah, and for some reason USA had to do a lump sum check. They said they had to, that they didn't have any choice. It just seemed bizarre to me. So when it comes to deferred annuities, not payout annuities are easy. You just whoever gives you the highest monthly income, take that one. So you compare 5 or 6 companies. I was going to show you one. I'll maybe do it next class. Hopefully I remember. Um, so the FERP annuities are a little tough to comparison shop, but payout annuities are a piece of cake. Whoever gives you the highest amount, do that one. For deferred annuities, you have to worry about surrender features. They can be quite significant. They might say, hey, if you change your mind in 2 years, we're going to take a 12% of your money as a penalty, and that'll usually decline over time. USA did that. You start off at 10, you kind of come down. The problem USA had is those surrender fees decline over time. And USA had about $3-4 billion in what they called legacy annuities, where the only surrender penalty was 25 bucks. If you have a $200,000 annuity and your penalty for every early withdrawal is 25 bucks and it's paying 6%, you can get 10% at a bank CD. Why not pay to 25 bucks? Crediting rates are obviously really important, but remember they can change those every single month. So there is a bait and switch where when you're paying attention, they offer a really good rate and then the rest of the time, really bad rate. So really focus in on the history, how competitive. That's why I always say compare to USAA, because at USA, they specifically say they will be in the top 25%. And so if you're competitive with USAA, you're in the top 25%. So there's an easy one. That's actually in their standards. So, find a company you trust and compare against them or just buy from that company. A guaranteed minimum crediting rates. This is if interest rates fall, they have to pay you at least 1.5% or 2%. Now, when I started at USA, their guaranteed minimums were like 4.5%. It's like 4.5 would be a really good rate today, but that was their minimums. They can never go below that. So they had some really great minimums. And then they do charge fees, administrative fees, and they can be quite significant. So look at that. So you really need to look at all of them. It's tough. It really is tough. I think the bottom line on these is pick a company you trust. But there's some good companies I don't trust on the sales commission side, but their deferred annuities are perfectly fine. So, it's a mixed bag. It's a tough industry to do business with because of some of the ethical issues they have. We'll talk about longevity annuities a little bit later, but here's an article on the longevity annuities from the New York Times some time ago. They say it's a relatively new product. It's not so new now, but it's not sold. People just don't do it. So what a longevity product does is it's kind of like an immediate annuity, but with delay. So an immediate annuity, you walk in, you give them 500,000 bucks, they start paying you $5,000 a month until you die. With a longevity product, you walk in, give them 500,000 bucks, but they don't start paying you for another 15 years. So essentially what they're saying, they say, bring in all your money. If you live, you make a fortune because you get the money from the people who died. So there's a delay. I'm going to show you a better product than this one. I don't like the ones in this article. So part with $1,000 for a benefit that may never receive. The insurance removes some of the uncertainty how much you can afford. So we talked about that before, right? It enables you. This actually says it better than Article 3. It enables you to spend down your portfolio more aggressively. Why? Because if your portfolio runs out of money, the insurance company keeps paying you. They take that risk. So it is a huge advantage. Some companies allow your heirs to receive some of your money back, but if you do that, that's going to reduce how much money you can get. And then they give some examples, and I hate these examples. So I'm going to show you how I would set it up. But you can see how they do this. You have to worry about inflation, but anything you do to try to correct the inflation problem is just going to reduce your monthly income. So yeah, these products are just not that good. So you have to worry about the credit quality of the insurance company because you're essentially sitting with this company for 20, 30, 40 years, so if they go out. So MetLife offered one of these, and here's their product. I don't think it's any good, but I called up MetLife and went and met with them, and the sales guy was just ridiculous. He knew I was head of equities at USAA, right? I'm head of the entire stock, and he was explaining to me how the stock market works. I was like, I think I got it. Uh, Strange guy. And then he called me like 3 years later because MetLife laid him off, and he wanted to get a job at USAA. It's like, I can't believe you still have my number. He thought I was a plant that was there to steal all their secrets, but I was actually there just for this class. I just want to know, how does your annuity work? And he said, well, we can't sell it to you anyway. So he tried to sell me a variable universal life policy. And it's like, yeah, I definitely don't want that. You need to take my class because you're talking all the stuff I hate. Strange guy. But that's what life insurance salesmen people are like. I mean, just didn't like that experience at all. But so I'm going to show you a better product. Essentially, the life insurance industry could really help people with the risk of living too long, but they haven't figured out how to do it and make money, and so they're not doing what they should be doing. They could help out society tremendously, but it's like we can't make money doing it, so we're not going to do it. I already talked about, oh, well, this one, we'll start here. This is an interesting case. This is a guy who figured out how to beat the insurance industry at their own game. And he won, and the insurance industry got really mad. There's like, hey, we're the ones supposed to be ripping people off, not you. And they got really mad at him. So we'll talk there. So we'll stop there. I don't know when our exam is, but it's coming up at some point, right? Y'all know when it is? Is it next week? Week after. All right, well, you already know what's on the exam, but I'll put an exam review out there anyway. But yeah, we're getting close on that one.